Hello and welcome to this Q&A brought to you as part of Livewire's Alternatives in Focus series. I'm your host, David Thornton. Today we're lucky enough to be joined by Peter Nielsen, Partner and Global Head of Wealth at EQT Partners, to discuss why now might be the right time to pivot towards private markets. Peter, welcome.
Thank you very much, David. Thanks for having me.
Private markets, private equity, it's gaining a lot of momentum at the moment, but for a lot of investors it's still very opaque. Why should investors consider private markets?
So I think you're rightly saying it's right now, but I actually think you should have a longer term view. So you should have considered private markets for some time actually. And why is that? So if you step back and look at the context, there's about 140,000 companies that have a revenue above $100 million. So 140, there's only 19,000 listed companies globally. So really, if you're not considering, investments outside the listed markets, you're missing out on a very, very large proportion of the opportunity set. So that's one of the reasons I would mention as a starting point. And then of course also the returns. So if you look at broadly speaking, the returns in private equity, if I look at a period going from roughly a 30-year period from 1981 up till 2021, the buyout index, which is the private markets US buyout index, has returned just under 17%, whereas S&P 500 has returned about 10%. So that's quite a gap.
Are companies staying private for longer, companies that otherwise might have listed in the past?
Yeah, I think it's difficult to kind of give full evidence, but if you look again at data, it's always good to have some data points, right? And in the US, basically, the stock market peaked in 1997. Ever since, it's slightly been declining, so the number of listed companies have gone down. And why is that? That's partly because it's not as attractive to IPO, but also maybe not as attractive to stay on the listed market. So you're absolutely right. It's just companies stay out of the tight regulation and governance for longer.
You mentioned before the 17% return thereabouts you can get in private markets. How consistent have those returns been historically?
They've been quite consistent over the various cycles we've experienced over the last 30 years. But clearly, I think that this is important to mention. There are, just like in the public markets, there are private equity managers that are doing very well, and there are some that are doing less well. Actually, I think in private markets, the dispersion between the managers that do well and the ones that do not so well is quite high. So you've got to be very careful on who you invest with, basically.
One of the big concerns in private markets at the moment is revaluations.
Yeah.
Is this affecting EQT, and if so, how are you working to mitigate that risk?
Yeah, I think no one is immune for what's happening at the macro level, and debt markets, of course, also play a big role here. But I think at EQT, what we've been doing for many, many years, we've had a sector focus. So really trying to invest in companies that are non-cyclical, i.e. companies that don't really, perform good or bad in cycles. So what are they? Like healthcare. Good examples maybe, Icon down here in this region, right, providing cancer care. It's really not cyclical. There's always, unfortunately, always a need for that type of, care. And the same goes on the infrastructure side, right? If you are in companies like right now producing electricity, so that's in high demand. So therefore, that's not really feeling the macro levels that we see today, or the changes in the macro levels.
Private markets have traditionally been the domain of institutional investors and family wealth officers.
Yeah.
Is that changing, and what opportunities are there now for retail investors?
Yeah, I would say, unfortunately, you're right. That has been the case. And why is that? That's because most private equity providers, including ourselves, for a long time, have only gained access or granted access to institutional investors. So large tickets, basically, so in large investments. And that's really what is changing. So I think we have seen and heard from, a lot of the wealth advisors that can we help overcome, these large ticket items. So you have to be very wealthy, and also the liquidity side, that if you sign a commitment, you're bound for 10 to 12 years. And we kind of, thought about that for a long time. It's basically taken us 3 years to come up with solutions that help investors. So you can get in at a lower rate, and you can also get out periodically instead of being closed in for 10 years.
Globally, there's a lot of dry powder at the moment within private equity. Are there the opportunities to put that capital to work right now? And where are you seeing those opportunities?
Yeah, there definitely is. As I mentioned, there's a few things. As I mentioned before, we tend to invest in good companies and make them great. Basically, we call future-proof the companies in sectors that are more non-cyclical. But if you look at the markets today, there's great opportunities, and we've taken advantage of that to take companies that are listed and take them private. So that's a great opportunity right now when markets are, a bit more muted as they are today.
So what kind of sectors and companies are you targeting at the moment?
So as I mentioned, healthcare is one of them. There is certainly also digitalization, technology, and the whole, as I said, whole electrification side of things that we pay close attention to.
Just to round it out, tell us about the new fund for EQT. What kind of investors are you targeting, and what's it all about?
Well, it's basically, as I said before, right? Unfortunately, if you think about it, the wealth creation morphs and will morph in the next 20 years, I think, more towards the individual investor. Everything if you think about state pension or your work pension, yes, it will still exist, but it's probably decreasing, which means you as an individual have to save more. So we have to make sure that private market investments are getting available or made available for the private individual. So when you think about your retirement and you want good returns on your investment portfolio, that's what we are looking for. So that's why we are creating vehicles like the one we've created now, which has a bit of liquidity as well, that can basically cater for the demands of the private individual. So super exciting times.
Tell us more about that liquidity risk. Of course, that liquidity risk comes with a liquidity premium that investors can expect. Yeah, how should investors think about liquidity as it pertains to private markets?
Yeah, I think historically, you have, as I mentioned, locked up your money for a period between 10 and 12 years. And now with vehicles like the one we're bringing to market, right, you should think shorter horizon, but not really short term. You should always think about your asset allocation. You have a liquid portfolio. If you have a need, a birthday's coming up, a wedding, whatever it might be, children are coming around. But there's a portion of your investment, maybe that's 5, 10, 15%, that you can put away for longer. And I would say a product like ours, you should really have a view that is at least 3 to 5 years.
This has been a great chat. Thank you for joining us, Peter.
Thank you for having me, David. Excellent.
If you like that interview, please give it a like, and don't forget to subscribe to our YouTube channel. We're uploading more content like that every day. See you next time.